Have you ever stopped to think about how a geopolitical conflict playing out thousands of miles away can actually directly drain your wallet? And not just that, but completely rewrite the rules of the entire UK economy. It's honestly a fascinating chain reaction. Today, we're going to trace exactly how these massive events in the Middle East are landing right on your kitchen table.
Hello and welcome. I am absolutely thrilled to guide you through this explainer today. This is a NumiSave.com presentation where we take these huge, complex global events and we break them down into really clear visual data. We're looking at the numbers, the hard facts, and the real-world impact on UK household finances. We're leaving the politics at the door for this one and focusing entirely on the economics.
Okay, let's dive into this. Here is our roadmap for today. We'll start with the global energy shock, move right into inflation and interest rates, and then examine the cost of driving. Finally, we'll explore two massive structural shifts, the £78 billion retail black hole and the defensive savings surge.
So to really understand the UK's current economic landscape, we have to look first at the Strait of Hormuz. Because of the recent geopolitical events and the US-Iran conflict, shipping traffic through this crucial choke point has seen just a massive decline. Now, as an economic explainer, we aren't taking sides in the conflict itself. We are purely analyzing the incredible domino effect. When supply chains in the Persian Gulf freeze up, that shockwave hits the UK mainland almost instantly. And that brings us to our very first domino in this chain reaction.
Section 1. The global energy shock. The sheer scale of this bottleneck is just staggering. The International Energy Agency estimates that around 20 million barrels of oil per day have been affected by this drop in shipping. Just to put that into perspective, that is roughly 10% of the entire world's daily oil production temporarily bottlenecked. And when 20 million barrels suddenly go missing from the daily market, well, the price of what's left absolutely skyrockets. Brent crude oil, which is the big international benchmark, surged right past $100 a barrel. Here in the UK, wholesale natural gas prices spiked by roughly 75% in just the early weeks of the conflict. But it's not just fuel. The Persian Gulf is a massive hub for fertilizers and helium, too. Qatar alone produces about 30% of the world's helium, which is literally essential for making semiconductors. So we aren't just talking about the cost to heat your home. We're talking about the cost to grow our food and build our electronics. So how did those global commodity spikes actually land on the desks of UK policymakers? Section 2. Inflation and interest rates.
Now, what's really interesting about this slide is the dramatic pivot in expectations. Before all this kicked off, the Bank of England was happily forecasting that inflation would drop right down to their 2% target by April 2026. But because of this massive external energy shock, they've had to completely tear up those forecasts. Instead of that nice 2%, inflation is now projected to peak somewhere between 3 and 3.5%.
And this creates a huge headache for the Bank of England. Domestically, the UK economy really isn't running too hot at all. But because of this imported inflation from the war, they've basically been forced to freeze the base interest rate at 3.75%. So all those rate cuts that the markets and mortgage holders were desperately hoping for this year, they've been completely stalled.
And the macroeconomic pain here is very, very real. The National Institute of Economic and Social Research actually estimates that the UK has lost a staggering £28 billion in economic growth this year alone, directly because of this conflict. It's a textbook stagflationary shock. You get higher prices, but lower growth. We've looked at the macroeconomy, sure, but what does this mean when we zoom in on the micro level, like your daily commute?
Section 3. The cost of driving. A massive divide is opening up right now on UK roads. The Energy and Climate Intelligence Unit ran the numbers for the first 100 days of the conflict, and this brilliantly illustrates the contrast. A standard diesel driver paid roughly £255 more to run their car compared to what it would cost to drive an equivalent electric vehicle. Petrol drivers weren't far behind either, paying £175 more. Meanwhile, EV drivers remained largely insulated from the whole oil shock. When you multiply that across the entire UK car fleet, the numbers are just mind-boggling. In just the first 100 days of this conflict, petrol and diesel vehicles cost an extra £6.3 billion to operate. That is £6.3 billion drained directly out of the pockets of UK households, purely because of a spike in global oil prices. The situation is actually severe enough that we're seeing emergency contingency plans being drawn up. The IEA has recommended COVID-style measures, things like working from home, carpooling, and even lowering speed limits to curb that oil demand. Domestically, the UK government is working really hard to prevent any 2021-style panic buying at the pumps.
Meanwhile, Prime Minister Andy Burnham has stepped in with new cost of living policies, including a winter VAT cut on electricity bills and capping bus fares in England to help absorb the shock for everyday commuters. But listen, if households are spending billions more on fuel and energy, they certainly aren't spending it elsewhere. Let's look at what that means from the high street. Section 4, the £78 billion retail black hole. This right here is the data point that has the retail sector absolutely terrified. According to analysis by EY, if household spending proportions had just remained the same as they were before the pandemic and these current geopolitical shocks, households would be spending an additional £78 billion right now. That is a massive spending gap ripped straight out of the UK high street. So where was that $78 billion supposed to go? Well, it was destined for discretionary sectors. We're talking clothing and footwear, restaurants and hotels, recreation and culture. Overall, consumer spending growth in the UK was originally on track for 0.9% this year. Because of the conflict, that forecast has collapsed to just 0.3%. It makes sense, right? When energy and mortgages eat up the budget, dinner and a movie get canceled. But it's actually not just about people having less money, though. It's about a really profound psychological shift in what they do with the money they have left. Section 5, the defensive savings surge. We are witnessing a massive structural shift in spending habits. Back in 2019, households spent a much larger portion of their income on fun, discretionary items. But today, essentials, things like household energy, your mortgages and rents, swallow up 49% of disposable income. Discretionary spending has shrunk down to just 42%. We are fundamentally having to spend more just to keep the lights on and a roof over our heads. So the crucial point is what happens to the rest of the money. You'd normally think that with higher costs, savings would just disappear, but geopolitical instability creates fear. Across the board, average household savings rates have actually jumped from 7% in 2019 to 9% today. People are hoarding their cash, and among higher earners, that savings rate has surged from 10% up to 13%. And this stat right here is exactly why the broader economy is hurting so much. High-income households have slashed their discretionary spending from 50% down to 44%, specifically to build up financial buffers. Why does this matter so much? Because the top 2 income brackets in the UK account for 56% of total consumer spending. When the biggest spenders get spooked by a global war and decide to aggressively save instead of spend, well, the entire retail and hospitality sector feels the freeze. Which leaves us with this final vital question. Is this defensive saving just a temporary reaction to the current Middle East conflict, or has this era of geopolitical instability permanently rewired the UK consumer to just hoard cash? Because if it's permanent, the UK economy is going to look very, very different in the decade to come. Thank you so much for joining me for this NumiSave.com presentation. I really hope these insights helped illuminate exactly how global dominoes fall all the way down to our own bank accounts. Stay curious, and I'll see you in our next explainer.